The single most important thing to me in the stock market for anyone is
Peter Lynch is one of the best money managers of all time. He managed the best performing mutual fund in the world, the Fidelity Magellan Fund, from 1977 to 1990 and returned 29% annually. This is more than double the returns of the US stock market during that time. In this video, I will try to summarize his investing philosophy and advice from various interviews in his book, Beating the Street. Peter Lynch is most famous for his mantra of buying what you know. This means that if you're investing in individual companies in the stock market, you only want to invest in companies that you like and that you can understand. If you can't explain the investment idea to a group of 6th graders, you shouldn't own the company.
the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
And if you're in a situation where you don't know anything about any industry and you want to start investing in individual companies, pick an industry you like and start learning everything you can about it. Buying what you know is incredibly simple and important advice. Peter sums this idea up brilliantly in this interview.
Imagine if you were in a mall the last 30 years.
Yes.
You would have seen The Gap. You would have seen Best Buy. You would have seen
Exactly.
Circuit City. You would have seen these companies that are crowded doing something better. And they're buying biotechnology stocks or oil companies. It makes no sense to me. If you're in the steel industry, you see it go from awful to better.
Yeah.
Why don't you buy a steel stock?
One of my favorite quotes from Peter Lynch is that if you don't study companies, you have the same success buying stocks as you do in a poker game if you bet without looking at your cards.
I'm all in.
Pot limit, brah.
Without looking?
Without looking.
Pretty sure he looked.
And don't think it's going to be really easy to find these companies that will make great investments. Lynch has said that to find one good investment, he typically had to research around 10 companies. Buying what you know sounds incredibly simple, but what does it actually look like in practice? Here's an example. When Peter Lynch just started running the Magellan Fund in 1977, he invested in Taco Bell. His thesis for investing in Taco Bell was that he liked their tasty tacos and he researched the company further. At the time, it was relatively unknown and 90% of the US hadn't been exposed to the tasty tacos. This gave the company a long runway to grow. Taco Bell had a good history of operations and also had a strong balance sheet. There was also a huge dip in the market at this time which allowed him to buy Taco Bell very cheap.
In 1972, the market went down dramatically and Taco Bell went from 14 to 1. They had no debt, they never had a restaurant close, and I started buying at 7, but I kept on to it and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out.
Buying what you know was the cornerstone of Peter Lynch's success. It's really important to remember that behind every stock there is a business, and if you focus on the company and find a company that can do well, the stock will do well.
You're nice enough to say nice things about Magellan, but in those 13 years, 10 times it declined over 10%. You know,
but you wouldn't go scared because you'd
score.
invest in a company.
That's right. I'd just say if the company's fine, it's fine. I mean, basically, Johnson & Johnson's higher than it was 40 years ago. Their earnings are higher. Xerox is lower than it was 40 years ago. The earnings are lower. So
Yeah, of course.
It's what happens to the company.
Here is the story of Peter's time at Magellan. According to his book Beating the Street, where he discusses his time at Magellan, when he was running the fund, he never had an overall strategy. He would just look to find companies that he believed would make great investments. He categorized his investments into 3 broad categories: fast-growing small and medium companies like Taco Bell, undervalued cyclicals, which are companies that are affected by the cycle of the economy, such as car manufacturers like Ford. He would buy these companies early in the economic cycle so that as the economy improves, these companies like Ford improve as well. The third category was special situations, and he defined this as any companies that he thought was worth more than the value that the market was giving them.
But until you want to invest directly in individual stocks, start a paper portfolio. Say, I'm going to buy these 10 companies, and then write down in like 5 bullets why. What's the reason I bought those? And then keep checking a year later what happened. Did they really keep growing, or did a competitor come along? Do a paper portfolio, and you can do exactly what I did with a real portfolio and find out what am I good at, what am I bad at? Am I really good at turnarounds? Am I good at small growth companies? Maybe I pay too high for stocks. You can do this over 4 or 5 years and learn what's your skills, and then specialize in that. I had owned thousands of companies. You know, the average person, all you need is a few in a lifetime.
His strategy involved a lot more buying and selling than a typical long-term investor like Warren Buffett, but the principles were very similar. To give you an example of this, in 1980, 25% of the fund was in out-of-favor insurance companies, and then in the next year he was completely sold out of these insurance companies and now into bank stocks. He was always exploring overlooked companies that were being undervalued or ignored by the market and Wall Street. Ignoring the crowd and really trying to understand these unfollowed companies was a great reason for his success. He also had a lot of stocks in the portfolio. In the early years, the portfolio contained anywhere from around 80 to 130 stocks, and it was around 450 to 900 when the fund was managing billions of dollars. This gives you a brief overview of his strategy and how he was investing back then. Some of his best companies were well-managed growth companies with a history of good results and where earnings are on the rise. This is the land of many baggers. It's not unusual to make 10, 20, or even 30 times your original investment, he said. Once you've found an individual company, these are the things you want to be looking for. First, you want to see that the business is improving, that sales and earnings per share are moving forward at an acceptable rate, and second, that you can buy the business at a reasonable price. Consider the financial strength and debt structure to see if a company has a few bad years, would that hinder their long-term growth prospects. One important thing is to try and understand the reasons for past growth, and if you're able to find out the reasons for past growth, you can make good judgments on whether you think this growth is going to continue into the future. It's super important to remember that stocks will only go up if the company is improving. It can go from terrible to okay, okay to good, okay to great. If something improves, the stock will go up.
If you're working hard, you're always checking with competitors, you're checking with customers, suppliers.
Right.
You're trying to do work to find out, is this company still early? Do they have years and years of growth ahead of them? Then you stay with it, no matter, the stock goes down. The key thing is when the stock goes from 10 to 6, if you understand what they do and you know they're financially solvent, you're fine. If you don't understand it, you're probably going to do the wrong thing.
And one important thing to always ask yourself is, if I'm right with this company, how much am I going to make? And if I'm wrong, how much am I going to lose? Lynch wasn't right all the time. In fact, he says he was only right 6 or 7 times out of 10. But when he was right, he made a lot more money than he lost.
I would say when I ran Magellan, I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So
another important part of Lynch's success was his mental fortitude and stomach.
And the key organ in your body in the stock market is your stomach. It's not the brain.
You may be able to find good companies, but that's only one part of it. If you can't handle the volatility and your stock's dropping 10 to 30%, you won't be a very good stock picker. Lynch has said that your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed.
All you have to know is you're going to see, it's always going to be scary, there's going to be always something to worry about, and you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well, and that's all there is, and I'm ready for questions.
There will always be something going wrong in the short term, but you need to think about the long term and the success of the company.
What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines.
Because of this mental model, he was able to take advantage of dips in the market. A 10 to 30% sell-off is of little consequence. The latest correction is an opportunity to acquire more shares at lower prices. This is how great fortunes are made over time.
I think volatility is terrific. The market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it.
This leads to the next point of never buying when the fundamentals are deteriorating. It's a shame to buy more of a falling company because it looks cheap. And when he saw the fundamentals deteriorating, he would usually sell out before huge losses.
When you sell your great companies and add to the losers, it's like watering the weeds and cutting the flowers.
some of my best stocks have gone from 18 to 8, then to sometimes to 40, and some have gone from 18 to 0. But at least I wasn't adding to it on the way to 0. A lot have gone to 0.
So if it's going down, you're not adding to it? I mean, sometimes you are.
If the fundamentals are getting better or the same.
Yeah.
But if they're deteriorating, I'm going to leave.
That's a reminder to always look at what the business is doing. Just because a stock is cheaper than before is no reason to buy it. And just because a stock is more expensive is no reason to sell it. You need to look at the business prospects.
If you don't understand the company, you have this problem when they go down. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at $3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put, if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say, it's 3, how much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. You have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is, the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say, they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day.
And to keep up to date with all the business prospects, you need to read the annual and quarterly reports. For this reason, Lynch recommends individual investors only investing and researching in as many companies as they can manage. For a part-time investor, this could be anywhere from 5 to 15 companies. At the year end, you should go over the portfolio company by company and try to find a reason why next year will be better than the last. If you can't, ask yourself, why do I own this company? To summarize, here are the fundamental principles of Peter Lynch's philosophy. Buy what you know. Behind every stock there is a company, so follow the company. The stomach is the most important muscle in investing. Make sure you build the right temperament by not selling during crashes. Only sell when fundamentals deteriorate or when you find a better company. I have tried my best to summarize his investing philosophy. However, I'm pretty sure you guys would rather hear from Peter Lynch. So right now I'm going to leave on screen all of Peter Lynch's golden rules of investing. These were mentioned at the end of his book, Beating the Street. I'd highly recommend you guys read this book. It's a great read, and it really starts to get you thinking about how to research companies and the life as a stock picker. I hope you guys have found this video helpful. Remember to hit that subscribe button so you don't miss out on other videos like this where I investigate the philosophies of some of the greatest investors of all time. One really cool thing from Peter Lynch's book is some of the charts that he uses in the book. There are some of the stock charts for different companies where he has their earnings line graphed and also their price line graphed. If you want to learn how to make this graph for different companies with a little bit of coding, let me know in the comment section down below and I will be sure to make a video on that. Thank you so much for making it to the end of this video. I really hope you have a great day.